listening to the Spicy Dividend. Hey, welcome everyone to the Spicy Dividend podcast. Today is a topic that I think is going to be pretty interesting. It's going to make you think twice. That's pretty much what this podcast is all about, right? You're a dividend investor. I kind of make you think differently about how you invest, your investing strategy, why you're investing the way that you are, make you think about it, give you that psychological aspect to investing that not a lot of other people like to talk about. Investing can be very black and white. This podcast is meant to be as colorful as possible. So, hope you enjoy this episode of the Spicy Dividend podcast. As always, this is not investment advice, strictly for entertainment purposes. Only consult your financial advisor if you are looking for advice. Hope you enjoy this one. I think it's going to be a good one. It's going to be one that maybe a lot of people disagree with, but that's okay. That's not why I'm here to, join in all the groupthink. I'm here to be the differentiator and make you think twice. So let's get into it. And they're off. All right, let me just say one thing before I get into anything investing-wise, that if you are going to go against the crowd, even if you're someone like me who is not a confrontational person at all, like I do not like fighting with people at all. I'm very passive with investing and with confrontations. If you have a different mindset than everyone else and you speak it like I pretty much do on this podcast and on my YouTube channel, which by the way has changed from Dividend Grinder to Degenerate Dividends, I'll let the YouTube channel decide that one. I'm not going to bore you with that on the podcast. But if you're going to go against the grain, just realize you're going to have a lot of haters on your back if you make your opinion publicly known and it is going against the grain. Not a lot of people like that. And, I found that out very quickly. And, it's kind of tough for me sometimes because I am such a lax, non-confrontational person. I might get angry and do rants on this podcast, but that's pretty much my way of venting and getting it out because I'll never go up to a person and verbally assault them or, go up to them and threat them or anything like that, or even doing stupid stuff like commenting on their videos or disliking their videos or commenting on their Twitter feeds, Instagram feeds, whatever it is. I will never do that. I would never go up to a person and just comment negative things. There's a difference between being a healthy criticism and just being an asshole. And, through this very small 1.5 year journey, I have just developed many asshole compadres. And, whatever it is, when you have a differing opinion, that's just going to happen. It's like I come off as this bad guy, the Darth Vader of dividend investing, when in reality, no, I just have a different viewpoint. I'm not really attacking anyone. I might criticize a lot of people, but like I said, I'm just going to do it through this platform. I'm not going to go to them or comment directly to them. And, it's the internet. People just do it all the time. They're just going to attack you directly. And, that's just how it is. So whatever, it's the world we live in. Just keep that in mind. If you're going to think differently, if you're like me and non-confrontational, it's probably best to just keep it to yourself. All right, with that out of the way, I hope that was an interesting little segment. This one should be a little bit more interesting as it pertains to dividend growth investing. I firmly believe dividend growth investing is amazing, but it is not amazing for dividends. All right, so what are we talking about here? So, dividend growth investing, you have to hold for very long periods of time. And I think everyone who's a dividend investor realizes this. They have no issues with that. Okay, that's fine. Because basically, with dividend growth companies, they might start out with small yields, but your yield on cost over time goes up really dramatically. And the dividend payout is going to get increased theoretically annually with positions that you hold. So by the time you've held for 30 plus years, you're receiving a lot higher in dividend payments than you have been in the past. And you might not, ideally you would put in a lump sum investment, and your yield on cost would be amazing. But, realistically, how is that likely for a lot of people out there, that they're going to have enough money, substantial capital up front to put into these positions where your yield on cost is actually substantial? just keep this in perspective. If you put like $20,000 into a certain stock, and let's say from that $20,000, you're receiving, let's make something realistic. So 20,000, 10% would be 2,000. Half of that is 1,000. Let's say you get 5%. So you get $1,000 a year, and that's being really aggressive on a dividend growth companies. Now, there are some that do it. There are dividend companies that have high yields, starting yields like that, and improve their dividends over time. But let's just say it's 5%. So you get $1,000 a year off your $20,000 investment. And let's say that's as much as you can put in at one time. That's your lump sum investment. All right, dividend increase comes around. Woo! Everyone's excited. The next year they increase their dividends. Woo! So now your annual dividend payments go from $1,000 to $1,080, 8%. Okay, cool, right? Like $1,080, that's more than what you had. But at the same time, that's not life-changing. Oh, you got to give it time. Okay, so you go from 1,080 and the next year they do their big raise. You're all excited and you get 1,160 in dividends. Okay, cool. That's fine. Fast forward again, 1,000, and now you're up to $1,250. The next year, it's been 3 years, and you've seen an increase of $250 actually coming into your account. That's not life-changing numbers. And you're going to have to wait many, many years for them to be substantial at all. And what the point is I'm making is $20,000 into an initial position. That's a lot of money. Not many people cannot afford. I know I can't afford just putting $20K in one position right now. I just can't just like, oh, hey, it's on sale, $20K. Here you go. Boom, boom, done. Many people do not have this option. They have to start really small like I did with $350 and then just work their way up, grind their way up. That's typical for a lot of people who are investing in the market. So your yield on cost, you might be yielding. If you're yielding like 100% yield on cost on something after like 30 years, you still have to have a significant amount of capital in there initially for that yield on cost to mean anything. Do you get what I'm saying with that? Like if you put $20K into one investment and after 30 years it's paying you, let's say 60% yield on cost. What is that? So 50% is 10K, 60%, why am I drawing a blank? It's like 11 or 12K. 12K, I believe, right? Then you make 12K a year off that after 30 years. That's cool. That's $1,000 a month. But if you're waiting 30 years for that, how beneficial is that? And keep in mind, everyone's like, oh, you'll reinvest dividends. Yeah, but the yield on cost is only effective on that initial capital purchase. So dividend growth investing is amazing. But I think people don't realize why it's amazing. The true reason why it's amazing. They'd say, oh, compounding interest, that's why it's amazing. No. There's a whole different aspect to it. The whole different aspect to it is that with dividend growth investing, you're allowed to do a complete 180 on your mentality with investing. So what do I mean by that? Typically, anyone who does dividend growth investing and solely does dividend growth investing, the whole reason they're doing that is for future dividend income, correct? Future cash flow income. A lot of arguments that people bring up for dividend growth investing is they'll whip up their studies. They'll find those 3 hallmark studies that are always brought up, and they'll say, look at this. It says right here, dividend growth companies outperform the overall market or outperform the S&P by like 1 to 2%, annually through this time period, this specific time period. And that's all fine and dandy, but keep in mind that only matters if you're a total return investor. So the whole reason of me talking earlier about like the yield on cost is only good if your initial capital is really high. That circles around to this point right here. Dividend growth investing is amazing if you're a total return investor. And that's great because a lot of people go in with the mentality of, I want dividends. And then they see that if they stick to the dividend growth investing and mix in what they consider value investing at the same time, they see their accounts go up and up. And, it pleases them because guess what? Your total return is really high. But your dividends really aren't that impressive. But the total return is, because you're buying value. And when you hit the value factor, one of the most important factors in terms of having successful returns over time, when you have value factor and profitability, which a lot of dividend growth companies have, you're going to see successful total returns. So you're saying, well, okay, that's great and all, but I'm still a dividend investor. If you are a dividend investor, you have to differentiate yourself. Are you a dividend investor who just invests for success? Or are you a dividend investor who is actually, truly investing for the dividend cash? And not enough people want to make that distinction, but you have to. You really have to make the distinction if you're in it for the cash flow or if you're in it for total return. So here's 3 really hot stocks that I'm going to talk about. I'm really mad at myself because I have all the true nitty-gritty numbers. I left it on my notepad at work. I am so pissed at myself, but I'm going to remember it best I can. So best case scenario so the 3 stocks we're going to be talking about are AbbVie, Pfizer, and 3M, right? Those are really hot dividend stocks right now in the dividend community. So they're all dividend growth stocks, right? They've been increasing it annually, some more than others, and they're all considered on sale, right? So the best example of something that can give you that dividend cash flow that you're desperately looking for when you're a dividend investor, if that's the route you're going, okay? If that's the route you're going, you look at something like AbbVie, where it was trading at its 52-week high with the dividend at the time, the dividend yield at that time when it was at its 52-week high, or this might have been the all-time high. I believe it was the 52-week high though. At that time, it was trading at a 3.2 starting yield, a 3.2% starting yield. Not that great, right? I mean, it's okay. It's better than the S&P average of like 2.1% or whatever it is. Not that great, but now you look at it, greatly on sale. You buy it now. If you bought it at the very low peak, your dividend yield is around 7%. That's fantastic, right? It's just below 7%, I believe, but you're getting that huge dividend yield. So that difference between going from at the absolute peak of like a 3.2% dividend yield to an absolute value of like high 6 point something percent dividend yield, that's impressive, right? Like that's what you're going for. A 6% yield is awesome. Let's look at the other two, right? Because everyone's like, oh, the value went way down. That means that I'm getting closer to my goal, right? Because I'm buying dividends and they're getting cheaper. Again, it depends what your goals are for your dividend investing. Because you look at something like a Pfizer who traded at 2.2% dividend yield at its height, and it goes on sale and everyone's like, wow, buy, it's really cheap. And it's a 3.5% dividend yield or 3.6% dividend yield. Guys and gals, you can buy high quality companies that are priced really high with dividends that are better than that, with dividend yields that are better than that. And you're saying, oh, you're not factoring in growth over time. And again, I have to reiterate, if you want your yield on cost to be impressive, then you really have to put a large chunk of capital at that moment when it's most valuable and you're getting the highest starting yield. If you want something like dividend growth investing to really be effective for pure cash flow. We look at another one like 3M when it was at its all-time high, which was in a 52-week range, trading at roughly 2.1%, which is nothing. Like that's S&P average, which is really low. And everyone's like, oh, look how cheap it is now. Buy. Blue chip company. It's growing its dividends annually, blah, blah, blah. And you're buying at the very bottom and you're getting like a 3.8% dividend yield. If you bought at the very bottom, that 2.1% starting yield to a 3.8% starting yield is nothing. I mean, that's nothing. It's nothing to really be that impressed about. And it's like, yeah, you bought it cheaper, but I could show you 1,000 other positions, not 1,000. I can show you hundreds of other positions that pay higher than 3.7, and their prices are outrageous. So you have to differentiate yourself between total return investor and cash flow investor. And a lot of people think automatically when they go into dividend investing that it's like, oh, I have to have this mindset of it's for the dividends only. It's for the cash flow only, so I never have to sell and I can just live off the dividend income. That's going to be extremely tough for many people out there. Many people out there have the dividend growth mentality. They start it young. They start in a Roth. Nothing wrong with that. Nothing wrong with that at all. Very tax efficient, very smart thing to do. And they have this envision that it's like they're going to, grow the account to like $1 million in 30 years, and they're going to have this awesome dividend yield, and they're going to live off dividends. It's really tough to do. It is very tough to do. Yields just aren't what they used to be anymore. And, you talk about all this dividend growth. You have no idea how many years a dividend going to increase. I mean, everyone thought back in the day, like AT&T was this absolute prime blue chip company that it's increasing its dividends yearly. It's doing it very highly, very consistently. Their last dividend raise was from 50 cents to 51 cents. Now, obviously, their starting yield is a lot higher than many companies, but you get what I'm saying? 50 cents to 51 cents, that kind of throws dividend growth out the window. And then you have these companies that are like, they trade at like 1.9% starting yields. Yeah, the growth is really accelerated. Like, oh, they're growing at like 10 to 15% every year. But I mean, you have to put a crap ton of capital right now in order to reap the benefits of that accelerated dividend growth. If you are going for pure cash flow from dividends. So this is why dividend growth investing is amazing. It's because you can completely 180 your ideals, not change your portfolio at all, and probably get better results than you were expecting. Dividend growth investing is kind of like a backdoor pocket for total return investors, and you could change your mind. It's like, you know what? I realize this really isn't working for the cash flow, but if I treat it for total return, hey, I'm competitive, sometimes even beating the S&P 500's total returns. So just continue it. Why grow my account to like $1 million and with these, companies that can yield 5% when I could grow to like $2 million faster doing it this kind of way and then go from there. Many people do. Actually, I don't think many people do, but a lot of people should consider the mentality of having dividend growth investing early, and I mean really early, and I mean putting in a large chunk of capital early so that it can truly reap the benefits of compounding interest along with that capital appreciation from being a good, stable company. And then when they get to their older stages, you can start converting to higher yields. Like that's kind of the dream, right? It's like people do growth stock investing to build the nest egg. And then once the nest egg is so high, then they convert to dividend investing. So, I mean, it doesn't always work that way. I think for me, I just get irritated with the mindset that people are like, I'm doing dividend growth investing for the cash flow. No, you're not. You're doing it for total return. And, people don't like hearing that, but it's just the truth. There are so many more efficient ways you can build your portfolios for pure cash flow than dividend growth investing. I mean, take my YouTube portfolio that I put out there versus like Joseph Carlson's. Joseph Carlson's at like 50,000 and he's averaging like $160 a month in dividend income. And then you look at something like mine, I'm at 34,000, $16,000 less. And I'm almost at the same amount of dividend income per month. And he says he's in it for the cash flow. I say I'm in it for the cash flow. My appreciation's doing just fine. So who's really benefiting more towards their goal? I would argue me in a heartbeat. My yield is much higher on my portfolio right now. And then he's saying, well, down the line, I'm going to outperform you. Are you? I'm getting more cash flow now. I mean, imagine my portfolio when it gets to 50K, when I get $16,000 more, probably a 5.5% yield on that money, I'm going to blow him out of the water in terms of cash flow. But he's going to blow me out of the water in terms of total return because he has a dividend growth portfolio, and they always do better in terms of total return. Now, there's other people like PPC Ian who does hybrid, right? He has a lot of dividend growth companies, and then he has companies that are high yielding, a lot of sin stocks, MO, and he has a couple other sin stocks that I can't think of off the top of my head, but they account for like 20% of the cash flow. And, this strategy kind of confuses me too. It's almost like you don't know what you want to be. It's like he's a person that says he doesn't care about capital appreciation at all. And if you're going to be someone like that, why don't you take your chances with something like a closed-end fund that pays 8%, has had no return of capital, and has been doing just fine in terms of appreciation as well? Why would you not steer towards that direction? Because if you have a crap ton of money in there for capital, well, you're going to reap the benefits immediately, and it's just going to grow even faster and quicker. I mean, you would be getting 8% off that money now. You don't have to wait like 10 years for that initial starting yield for a yield on cost to get you to that 8% if it's paying like 4% now. You don't have to wait that long. The capital churns a lot faster. You compound a lot faster. Everyone talks about the benefits of compounding interest. Well, imagine the benefits of compounding interest if your starting yield is really high. I see this all the time on a Facebook feed that I follow. And these people, the whole point of it is to retire on dividends. And these people will show like portfolios of nothing but closed-end funds. Now, I don't agree with that strategy either, like nothing but closed-end funds. But the one guy had like $2,400 a month in income off of only like $370,000. That's insane to me. A $370K portfolio giving you $2,400 a month in cash flow. The whole purpose of the group is to retire off of dividend cash flow. This guy's almost doing it off of $370K. That is not a lot of money. And if you think that's a lot of money for like a retirement account, then you're in deep water because you need a lot more than that if you want to substantially have income during your retirement era. Nonetheless, he's pretty much accomplishing what the goal is to live off of this income. $2,400 a month. Obviously, you can't live off of that unless you're in a really poor area or you relocate to Thailand or something like that. But that's only $370K. I could realistically see myself getting my portfolio to that point before I'm like 40 years old. Maybe a little bit later. Maybe like 41, 42. But nonetheless, you get what I'm saying. Well before I'm in those early stages of retirement. I mean, holy crap, that guy gets to, what's 370 doubled? 740? Did I do? Yeah, 740K, $4,800 a month. I mean, that is phenomenal. That is phenomenal. And that's one of his bad months, he said. That doesn't even include his quarterly payments. That's only monthly payments off of a 370K portfolio is $2,400 a month. Didn't even include his quarterly payments that he had. He excluded them. And a lot of criticism was, oh, well, what's your total return? What's your losses? Show me your losses. And I'm thinking to myself, why does it matter? If he's getting the income without selling, isn't that the whole point of living off of cash flow? Who cares? Do you get what I'm saying? Like theoretically, and obviously this is impossible, it's never going to happen. If you had a stock that consistently, let's say you had a closed-end fund that consistently paid you $1 per share, right? And something's happened to the company where the price went from $20, let's say the NAV went from $20 to $2, so now it's trading on the market for $2.50, but it continues to pay its $1 per share dividend. Now, obviously, this is complete hyperbole, complete exaggeration, never would happen in a million years. But I'm testing the theory, right? Your appreciation tanked. You lost like 90% in terms of appreciation and market gains, but your cash flow remained the same. So who cares? Because this guy's clearly investing for cash flow. You can't deny that. And you can't say he's not successful if his market gains is like minus 4% over time, but he's getting this ridiculous yield of $2,400 a month off of a $370K portfolio. That is a tiny portfolio in the grand scheme of things for when you're older, and he's making a butt ton of dividend income. So this whole podcast has just been, just what mindset are you really in with dividend growth investing? And I think it's fantastic that it's like you can mistakenly go into dividend growth investing if you don't want to do it for cash flow and just switch your mindset to, oh, I'm a total return investor now, similar to like what an index investor is, like just a total return investor. Give me total return. So the dividends reinvesting, and I get the growth and I get the dividends combined. We are one big happy family with this portfolio because total return's high. There's nothing wrong with converting to that. In fact, most sane people want total return as high as possible. Most sane people would look at it and say like, oh man, I grew my portfolio to $2.1 million. It's like my yield is 3.6%, which isn't high at all, but I grew it to $2.1 million. You'd be happy with that, wouldn't you? I mean, in most areas, you'd be happy with $2.1 million, and then you can turn it into an annuity or higher yields at that point. My point is, are you planning it that way? Are you planning it to just grow your portfolio through dividend growth investing as the tool and then switch over to higher yields once you're older? Or do you really want to go for cash flow? And when you really want to go for cash flow, that's got to start right now. You got to get those high yields up right now. And that's one area where I highly disagree with like 90% of dividend investors out there who say like, I'm in it for the cash flow. No, you're not. No, you're not. You think buying 3M when it's a 3.7% starting yield versus 2.1% at its peak is investing for cash flow? One of the most overvalued closed-end funds that I own right now, PIMCO Dynamic Income Fund, one of my favorites, is trading at a huge premium to its NAV, like a 12 to 13% premium, completely overvalued, right? Should not be anywhere near that. And it's yielding 8%. 8% on a way overvalued. Imagine what you're going to get given that the distributions are consistent, which they have been, and they've never paid return of capital. Imagine your yield if the price were to get cut in half during a recession and they keep their payments. 16% starting yield? And don't say it's unrealistic. It's happened before. Look at a company like Gladstone Commercial Corp. It might have been a lot of return of capital, but they've never cut their distribution from 12.5 cents a share. Their price during that whole great recession in 2008 through 9 dipped down to like $6 a share. 12.5 cents per share at $6 a share. Never cut its distribution. It was yielding almost 20%. Can I do the math real quick? Let's do the math real quick. 0.125, I'm on the calculator right now, times 12, $1.50. Divide that by the price of $6. That is a 25% starting yield. That is cash flow. I don't care if it was return of capital. That is cash flow. Because guess what? The price of Gladstone Commercial Corp is around $21 today. $6 at $21, never cut its distribution. That is insane. That is insane. This stuff exists in the closed-end fund world, the true cash flow world. Hope you enjoyed this episode of the podcast. One more thing before I go. Can we please stop calling Altria a contrarian play? Can we please? You know how many billions, you know how big Altria is, and Philip Morris. These are not contrarian plays. Everyone says like, oh, the people hate them. The government hates them. The government hates companies like Johnson & Johnson too. There's a reason they have so many freaking lawsuits. Every big company is hated at some regards. Just because Altria sells cigarettes, stuff that kills you and serves literally no value to anyone, just because it does that doesn't mean it's like hated by everyone. Yeah, maybe like Wall Street, the institutions don't like it, but it's not a contrarian play. Everyone and their mother has been buying Altria and Philip Morris lately for their starting yield. It's like, it's not a contrarian play. Stop saying it's a contrarian play. I've not seen like one person who's like a dividend investor that I follow that has not picked up like shares of Altria. It's like, it's ridiculous. There's nothing wrong with picking up shares of Altria. That starting yield is juicy as hell, and that's what you get with sin stocks. What I'm saying is, don't act like you're going against the grain here. Like, I'm sorry. Like, it's just a cash cow. That is a true cash flow investment, Altria. Don't say you're all dividend growth, blah, blah, blah. Yeah, I know they dividend growth. You're in that for under the cash flow. You're not in that for total return. You're in that stock for cash flow. That's a great example. You can invest in like Altria, AT&T, Ford, these closed-end funds. You can get like an 8% realistic yield without totally demolishing your portfolio. But people are like, oh, they don't grow it fast enough, or the appreciation's not there. Why do you care about appreciation? Anyway, hope you enjoyed this podcast from the Spicy Dividend. What are we at? Episode 13, I believe. Wow. Thank you so much for following me. If you're listening on Apple Podcasts, Spotify, Google Podcast, Anchor, whatever it is, thank you so much for giving me your attention. And thank you for the one hater on Apple Podcasts that gave me 1 star. Maybe it was JMac Investing. Nonetheless, thank you so much for everyone listening. Hope you enjoyed it. Let me know if you're listening on YouTube, which is at Degenerate Dividends. Let me know your thoughts on this mentality down in the comments below. From everyone else, you can see me on Twitter. Reach out to me on Twitter or Instagram. I leave a link to those in the description below wherever you're listening to the podcast. Thank you so much for listening. See everyone in the next one.